think that much of the drama is still to come.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. In the wake of the 2008 global financial crisis, central banks drove interest rates down to unprecedented lows and kept them there for the better part of a decade. The world economy then became addicted, some would say dependent, upon a zero-cost capital world. But now, inflation is forcing interest rates to rise sharply around the globe at the fastest pace on record. And this sea change in rates is depressing economic growth, shocking the financial system, and resulting in one of the worst years in history for stocks and bonds. To find out where things are likely headed from here, we sit down with the world's top expert on interest rates, James Grant, esteemed publisher of Grant's Interest Rate Observer. Jim, thanks so much for speaking with us today.
Oh, you're welcome, Adam.
Well, it's always a pleasure. And Jim, the only time I wear bow ties anymore, tie them anymore, is when you come on in homage to your wonderful nappy fashion sense. I'm looking at just how perfectly crisp your tie is, though, and realizing that my skills have really degraded since the last time I had to do this.
Well, I think, Adam, that 45 years or so more experience, you're going to be right up there in the vanguard.
Well, thanks. One more thing for me to aspire to in life, Jim, but you set a high bar. All right, look, I've got a lot of questions for you. I asked my audience in advance of this interview if they had any questions for you. I think that was a mistake because I literally got hundreds and hundreds of them. Very hard to boil them down. But before we get into the specifics, I just want to toss out a general question just as a starting off point here. It's my normal question. What is your current assessment of the global economy and financial markets? Answer any way you like.
Well, they're rather a mess, and they are a mess because I think of the consequences of the interest rate regime you described in your over-generous introduction, Adam. Interest rates literally have been at 4,000 or so year lows. They, in fact, plumbed sub-zero lows. At one point in 2020, no fewer than $18 trillion worth of so-called fixed income securities were priced to yield less than nothing, which would seem to be on its face a non sequitur, an absurdity. But certainly it's a reflection of the unprecedentedly radical and intrusive monetary policy of our central banks. So when the price of capital, at least with the money market interest rate showing, these kind of this treasury bill area of the so-called yield curve, when these very short-term rates are priced at zero or even less, people do all sorts of crazy things with money. There's a Victorian financial thinker and journalist called Walter Bagehot, who proposed that John Bull, he said, he was English, alluding to the national symbol. John Bull can stand many things, but he can't stand 2%, meaning that a rate as low as, like plus 2% would cause people to, as we say now, reach for yield to maintain their standard of living or the growth in their value of the portfolio or something. So they would, they would do things like, they invest in non-fungible tokens, maybe, or in some crazy venture capital promotion, or private equity scheme, or a bar of tungsten. Tungsten was a thing, not so long ago. So this is what happened the world over. 0% rates got people thinking about anything and everything in which to speculate, and fold in over that like zero cost commissions, a lot of downtime with which to watch CNBC and to listen to Adam Taggart. Not that they went wrong by listening to Adam Taggart, but we had what we know was the everything bubble. And I think the context in which to frame today's events is the legacy of those 0% rates, the behavior that those rates help to induce, and the wild and crazy Bloomberg screen that lights up and you can hardly believe what you see.
All right. So basically, they deformed the price of money by keeping rates incredibly low, deformed the price of capital. And no huge surprise, malinvestment ensued. We are now on the other side of that coin, where rates have risen off the floor at the sharpest rate of change, I think that's on record, or at least in the data sets that I've looked at.
Yeah.
So the system is, to a certain extent, now going into shock over this. We're seeing economic growth slow down really fast. We're seeing the worst start, or one of the worst starts of the year for stocks and bonds. Some would argue, and I would love to get your thoughts on this, that we haven't seen the worst of the shock from this sudden and sharp rise in interest rates, because there tends to be, a delay between when the Fed pulls a lever and when we see the full manifestation of that. So I guess on that question, do you agree with sort of the way I just described things, and do you see some of the shock waves from what's already been done, let alone what might be done from here, continuing to propagate through the system for some time?
Yes, I think the shock waves will be rather long lasting. For context, the last time interest rates had a sustained move to the upside in Wall Street jargon, the last time there was a major bond bear market, began 1946. And that bear market lasted until 1981. So this bear market began at a yield of, say, 2.25%. And it ended famously or infamously at 15%. That was the 35-year bond bear market of the post-war era. And it took that 2.25% yield 10 years to rise to 3.25.
Wow.
That was the tempo, adagio or largo was the tempo of that particular bear market. And compare and contrast the present day when, I don't know, one forgets a little bit how extraordinary it is, or one gets dulled to the fact of its being so extraordinary. But I think mortgage rates began the year like about 2%, and they're now 7% plus. I mean, it's some of these money market interest rates began the year at like nothing and are at 4%. So this is quite extraordinary, and indeed, I think, unprecedented. Interest rates have a long history. In fact, somewhere behind me is a book called The History of Interest Rates, which I commend to, well, to people who like that kind of thing.
Mm-hmm.
And in that book, you will see many things, but you will not see, because it has not been revised in the past few years, you will not see an episode such as we saw in 1920 through 21 and 22, where you go from $18 trillion worth of securities yielding less than nothing to like none of them yielding, or almost none of them yielding less than. It's really, it's quite a head snapper.
All right, so there's lots of implications from that, which we'll hopefully have time to dig into here. Let me just ask you at a high level here. What are these rates telling you right now?
Oh, they're telling me that on the hopeful side of the issue, they're telling me that the world is adjusting and coming a little bit to its senses, and compensating capital for the risk it bears for getting out of the bed in the morning and trying to do something constructive, being the object of a loan or an investment. So that's to the good. I think it reminds us, does this unprecedented up-tempo rise in rates, it reminds us of the level and duration of suppression of rates. There was a storyline that became quite popular, indeed quite profitable, over the past dozen years or so, that held that we live in a time of, it's got very fancy, of secular disinflation. Say secular meaning not religious. That's alludes to the long-term nature of the move. So they say there is a secular deflation or disinflation, and interest rates will be low indeed, approximately forever. And Ben S. Bernanke, PhD, the recent Fed chairman, indeed the winner of the
recent
Nobel
Prize
Prize.
recipient.
Yes, I think he said interest rates will not rise significantly in our lifetimes, which prompted me to say many years ago, well, he's not a young man, as Ben Bernanke, but he was right for a long time, and interest rates remained low, and as we say at Grant's, long level. And you began to think, well, maybe these guys are onto something. But no, it turns out that it was a case of main force, of a muscular suppression of rates by the central banks, I think. That's one of the things I read into this snapback. It's like, this proverbial beach ball held underwater, and it pops to the surface. I never did get around, Adam, to taking a crack at the question of the consequences of the suppression and now the release of these rates. Where will this manifest, and what will it mean, and when will it present itself in its full glory or a full fright? And I think, to take an opening swipe at this question, I think that much of it is still ahead of us. The companies don't pay interest every day. They pay it in a bond, in the case of an issuer of bonds, every 6 months. So it takes a while for companies to scrabble around and to try to adjust matters with their banks, and to try to organize themselves. And only later they find out that really they can't generate the cash flow with which to service the debt. And then so that there are lags, just as you suggested. So I think that much of the drama is still to come.
All right, and I'd be curious to sort of speculate with you, how that will manifest. For example, I was interviewing a fellow on this channel a week or so ago about, what are defined as zombie corporations, and there's a lot of different estimates out there about what percentage of the U.S. corporate fleet is a zombie corporation. But I think we can say it's non-trivial, and so. Could this potentially manifest that we see sort of a mass die-off of that end of the corporate spectrum?
Yes, or a mass, not so much a die-off as a change in the structure of ownership. We have bankruptcy procedures, and the bondholders, the senior creditors, are the ones that come into the equity portion of a company's capital structure when things don't go as planned. A zombie is, as I understand it, is a company that does not cover its interest expense out of operating cash flow. And the numbers one sees are surprisingly large. A surprisingly large percentage of the tech world, for example, answers that description. There's private equity as well. It used to be called leverage buyouts, but the shambles of the LBO crash in the late 1980s kind of prompted a rebranding. So now we call it private equity. But a private equity company is one that has been taken out of the public markets and placed into the hands of promoters through the generous application of debt. And as you can imagine, as the years of so-called 0% interest rate induced prosperity have rolled on, people have gotten bolder and bolder with regard to how much debt they're willing to slather on to one of these companies. And indeed, they have slathered a great deal, and the margin for error is not so wide. But as we have already noted, interest rates have gone up and up and up. And suddenly an interest budget that was, say, 200 million is now kind of 350 million. Can we do this? I guess we can do it. But whom do we have to fire? Not us, right? Nope, not us. Well, maybe some of the employees will volunteer. So there is all this is working its way into the system, and there's a chance, of course, that again, one cannot dogmatize on these things. My goodness, I made that mistake too often in the past. Yeah, 50 years, but because interest rates will not keep going up at this rate. If they did, they would be surpassing the old highs by Easter or some such. So one always leaves room for the unexpected in one's own pet scenario. But I think the odds are that the normalization of rates, such as it has been, is going to be an important story for many fiscal quarters to come.
Okay. I want to ask you this question, sort of market related a little bit, but then we'll get more into the details of markets later on in the conversation. As rates continue to go higher from here, and I don't want to put words in your mouth, but it sounds like you're saying you see at least the near term trajectory is still higher with rates.
I do.
Um, it is going to continue the current building negative wealth effect, right? So we're seeing a sell-off in markets, right? I mean, and there was a correlation between cost of capital going up and financial asset prices, especially
Right.
ones that have been based off of, basically free capital, zero cost of capital beforehand. So we're seeing that both in the financial markets, but we're also, as you indicated, we're seeing it in the housing market as well, right? And the housing market, I think, is still very early on in its correction, just from a mathematical,
Yes.
increase in mortgage rates because of the relationship between mortgage rates and price. The prices just have to come off. They've not come off nearly as much as mortgage rates have increased so far. And housing is much more commonly owned than stocks. So you can make an argument that the depressive effect of a negative wealth effect in housing is even more meaningful to consumer spending than what happens in the stock markets. But anyways, regardless, we've got both barrels of the shotgun on the negative wealth effect side. That's going to bring down consumer spending, which will contribute to the margin compression that companies are experiencing right now, right? So they're seeing, in some cases, reduced demand already, but they're also seeing a higher cost of capital and higher costs just from inflation in general. So you can make an argument that may lead to layoffs, which could contribute to even further reductions in consumer spending. So I'm not necessarily saying this is exactly what's going to happen from here, but are you concerned that these are the types of repercussions that we're going to see from these increasing rates that will then, continue to really impact the economy in a negative way going forward?
Well, I can't do any better with the answer to that question than you did with the asking of it.
Yeah. Well, that's a big honor. Thank you.
I think the sequence of events you laid out is exactly the one I would have thought of had I been clever enough to think of it. So I will go with I will say yes to that question.
I just had a life highlight here. Okay, but basically, I guess we're like-minded then, which is in terms of expecting further shoes to drop in the story.
Yes, the interest rate induced deformation, as you so well put it, is like a centipede, all sorts of shoes, and they'll be clattering to the floor of the bedroom as we proceed.
Okay, and like I said, I'm trying not to jump the gun and ask, like, okay, so what does this do to asset prices and markets? Because we're going to sort of end there.
What names are we using in here? It's like,
Yeah.
is the phrase you're reaching for.
Exactly. Okay, but as you said, we're not going to be able to continue on this pace of rate increases because by Easter we'll have exceeded the heights of the Volcker era. So there is some sort of threshold here where the economy is just going to roll over and basically go into cardiac arrest. And whatever number that is, whatever rate that is, it's probably a much lower rate than it was back in the Volcker era because we have so much more debt in the system now. So I'm just curious, is there a rate at which you begin to think, okay, I got to expect parts of the economy, wheels to start coming off, engines to start seizing up because we just can't function above X%?
Well, the economy is, by the way, the word "the economy" is one of these, it's, I guess, in its nature, amorphous. And the economy is people getting out of bed in the morning and trying to make something, right? I'm much more comfortable talking about the micro situation than the grandiose one, but the economy, insofar as we can conceive it, is an adaptive thing, and I'm rather impressed that at the adaptation that we have already seen. I'd say the thing continues to work, and I have been reading predictions that as soon as the federal funds rate gets to 2 or 2.5 or 3 or 4, that everything stops. Well, it hasn't. Now, these interest rates, as towering as they are compared to where they have been in recent years, are still way below the measured rate of inflation.
Mm-hmm.
We're awaiting new, as we say, awaiting new data. We are data dependent. We are data anxious, but it's still 8% as we count it up. It would be higher if we counted the old way, but we are counting it at 8%. And the federal and then 10-year Treasury yield is like a 4 number. And so creditors are still not being paid as they have been customarily paid, with a rate of interest or rate of coupon yield above the rate of inflation. So yes, I expect rates to press higher, and I expect noise is off as these rates do get into the works of a highly leveraged economy, and they may crimp things and create crises. And I don't know. I think private equity is a very good candidate for the first theater of operations in interest rate induced corporate crisis.
And is that, and I'm curious on that. So to borrow a phrase from Stephanie Pomboy, it sounds like you're saying those are some of the bodies that you first expect to start floating to the surface here. Is that something that can kind of happen and we can move past it, or is that, you use the term crisis, is that something that could trigger a larger cascade?
It can trigger a larger cascade. I think it's a $3 trillion phenomenon, this private equity business. But that's one. Maybe it's rather too obvious. But it's an interesting and kind of counterintuitive possibility for a point of difficulty, if not of crisis, is the Treasury market itself. Now, the U.S. Treasury is a commandingly strong issuer of debt. No, I mean it has, at least conceptually, it has the entire GDP of the United States of America at its disposal through the taxing power. Not to mention the Grand Canyon, other resources and assets it could probably pawn. So it's at least to be sure, it's split rated. Standard & Poor's doesn't make it any more than AA+, but S&P, Moody's has it AAA. But the Treasury market is a structure that is largely leveraged. It's leveraged because the primary dealers, so-called, the 24 or so financial institutions that are privileged to deal as counterparties with the Fed, are themselves highly leveraged. They borrow the money with which to hold their bond inventories. And they have not, I was about ready to say experienced, the word is suffered. They have not really suffered a prolonged bout of rising interest rates in the careers of the people who manage and work for them. Mm-hmm. So the Treasury market exhibited all sorts of tendencies towards dysfunction well before this interest rate drama started. There was an episode in September 2019. This is kind of a recondite inside baseball thing, but the so-called repurchase market. It was a market in borrowed funds used to finance inventories of Treasury. That market stopped functioning in the way that the Fed wanted it to function, and the cost of borrowing money with which to buy a Treasury bond in the wholesale market got 10% for an instant in September 2019. The Fed says, "Whoa, that is not smooth functioning." Smooth functioning is a term of art by the Fed uses. So the Fed, to reinstitute smooth functioning, began to buy Treasury bills. And Jerome Powell got up and said, "Now this is not QE. We stopped that." And everyone said, "Oh yeah, that's QE." And everyone was right, and Mr. Powell was wrong. And so the Fed blinked and restarted its credit pumping in September 2019, and then, of course, torqued that way up and under the pandemic regimen of 2020. So but the Treasury market is surprisingly fragile. And I could imagine, and you're hearing from, among other things, Secretary of the Treasury Yellen saying, well, we might have to do something about the Treasury market. We might. I don't like the way it's creaking and the noises it's making. It sounds like an old steam radiator the first day of winter. So what we might have to do is issue treasuries, issue Treasury bills, and with the proceeds of that issuance, buy Treasury bonds. Now, that sounds a little bit like QE, doesn't it? Or it sounds a little bit like yield curve control, and certainly it sounds like meddling. And my abiding complaint with the masters of our national finances is they will not let markets clear, and they will suffer no pain that can't be avoided through an artful intervention. Is what they, but they seem incapable of looking to the consequences of their interventions, especially imagining the unpleasant ones. So the interventions of September 2019 got us on an inflationary path that turned into something rather more serious in 2020, 21, and 2022. And they're saying, oh, we didn't expect that. No, you're always surprised. They're always surprised.
There's a demotivational poster that I like to show on this channel. The posters you see and the motivational ones you see in offices. This is the dark version of that, and it's called, I'll see if I can put it up here on the screen, but it's called Government. It says, I'm doing this from memory, but it says, if you don't like the problems we create, just wait till you get to a load of our solutions. so sounds like you're saying like that's just business as usual.
But this is public sector, private sector, we're talking about humanity, and humanity is we are a pro-cyclical species. We buy high and sell low. That seems to be a DNA problem, and but the Fed is itself a pro-cyclical outfit, right? It tightens into downturns and loosens into inflations. Witness the QE that persisted into, I think, March of this year. It's extraordinary. Mm-hmm. So the Fed, I don't, and making these little sermons or sermonettes against intervention. I don't mean to suggest that that human beings acting in markets unintruded by central banks are going to make a crisis-free world. They won't. We saw plenty of that demonstrated in the credit events of the 19th century. But I think the persistent and deeply costly problem that comes with habitual interventions is that little problems become big ones, and big problems become titanic ones, and the titanic ones become socially and politically poisonous. And we get people like certain presidents, one can name, that seem to bring out the worst in us. And now I'm going to stop saying that kind of thing because we're talking about interest rates.
All right. Well, look, I want to actually go to inflation now because that is what's been forcing the current central bank hand. And, I want to get to the question of, is there intervention done here? In other words, could we see a pivot at some point back to the extreme interventions that we've seen over the past, recent years? Real quick though, before I do, just because you brought it up, you said the U.S. Treasury market is surprisingly fragile, and we have been noting on this program the past couple of weeks, the concerning reduction in liquidity there and the increased volatility in Secretary Yellen's comments. How nuclear would it be if we had a real breakdown in the U.S. Treasury market?
I think it would be great copy for interest rate themed financial journals, for one thing. It would, I think, it would inspire or drive the narrative that the 10-year Treasury yield is the most important price on the planet. We can't price assets without a smoothly functioning Treasury market. And that would contribute to the discombobulation of all markets. However, I think that a unsmoothly functioning and troubled Treasury market would be an excellent reminder about the state of our public finances. Look, the feds, the authorities, the Treasury, and the feds, they say we don't have a stock market put anymore, but they will not deny that we have a bond market put. Right? They are prepared, and they make no bones about being prepared to intervene to promote the smooth function of the Treasury. But I say that the Treasury market ought to be discontinuous and illiquid and unsatisfactory if the supply of securities is greater than the demand for securities at prevailing prices. So the way to fix a dysfunctional market is to make the product better priced, and lo and behold, people want to own it. But if you suppress interest rates for a dozen years and you allow them up in a measured way, still below the rate of inflation, maybe the problem, not to overthink this, but maybe it's all mispriced. And if it's mispriced, let's price it properly.
That's a great point. So you would actually say that it would be a positive development,
Yeah,
because we would be letting natural market forces find true water.
The shoe ought to pinch. And then they say, oh no, you wear a size 10. Well, let's try a size 12 just to make sure it's roomy. No, but falling prices are Mr. Market's way of saying that something is out of balance. And indeed, the public debt, to cite a somewhat familiar set of data, has gone from 1 trillion when Ronald Reagan came on television to say we got to $1 trillion. This is 1981. So what else do you have to know about the state of our $1 trillion? You know what? And they said, $1 trillion. If you stack $1 bills to $1 trillion, you got to the moon. Or okay, that was then, and now it's 31 trillion. So it took from 1789 to 1981 to get to $1 trillion. Now, no more gold standard, no more, no more constraints, no more pinching shoes. And now we're at 31 trillion. So I think that the Treasury market ought to be dysfunctional.
All right, that's a great point. So while the headlines might be apocalyptic, and certainly there would be disruption and near-term pain, we probably actually should look at it as a welcome thing to hopefully price
because
our markets better.
There's no more. In the day, there were two things that constrained excessive borrowing and lending. One was the nature of the currency itself. It was collateralized by a precious, mostly gold. And that ended for America in 1971. And the other thing that constrains it is a market-derived, sensible rate of interest, which rations credit. And that ended for us in the cycle in 2009, 10, 11. So with neither market-derived rates nor with collateralized currency, we're kind of out there floating like Mary Poppins. And that, I think, explains the disorder of our finances. It's disorderly, right? I mean, people are doing crazy things. Elon Musk is a figurehead of disorderly finance. And it seems to me that ought to be a little bit less newsworthy. And also, we ought to hear less from our monetary masters. Adam, if I were in charge of things, we wouldn't even know the name of the Fed chairman.
Well, so I was going to get there in a bit, but why don't we go there right now? So, Jim, I make you Emperor of America. What reforms would be at the top of your list?
Everyone's got to wear a damn bow tie. Sorry.
Okay, well, clearly. Okay, yes.
But if my remit were properly and perhaps more reasonably limited to the monetary realm, what I would do on day one is say, ladies and gentlemen, we are markets are a nice thing, and we have for too long ignored them, and we are going to restore the discipline and the order and the outcomes, sensible and constructive outcomes that come with markets that function properly. So you are going to hear less from us at the Fed. And in fact, I hope that we are going to become invisible. You will not see us intervening to straighten out difficulties in the Treasury market. They ought to perhaps be attending to their own supply and demand issues over there at the Treasury bill. And we are not going to come and rescue the 401ks. We wish you well, but we are going to make it so that there's no inflation, no opposite of inflation. We are going to, So we're going to recede constructively into the wallpaper. And if I had my druthers, I might say at Taylor, I would like a reversion to the classical world of a classical gold standard. Now, that is a most unconventional thought, as orthodox as it used to be. And I will not ram that down anyone's throat, but just think it over a little bit. Meantime, we're going to just become a little bit less obtrusive. That's my speech.
Okay, so go back to a backed monetary system, possibly gold. In terms of setting interest rates,
Yep.
would the Fed do that in your world, or would it be a market set interest rate and the Fed really would just be there for emergencies to provide, short-term liquidity?
I mean, every central bank in the classical gold standard era set the discount rate at which it would lend against eligible collateral. That was a classic regime of the Bank of England and of the Fed when it started. It didn't last very long in the Fed. But the trouble is not with a central bank establishing a rate at which the gold value of the currency is properly sustained. The problem, I think, rather enters the picture when the central bank gets ambitious and says, long-dated bonds ought to be 2%.
Right.
Like the Bank of Japan ought to be 0.25%. So long-term yields ought to find themselves in the marketplace. That ought to be a market discovered. Oh, that's a wonderful word. That discovered in the marketplace rather than enforced from on high.
Right, and many would say, and I believe you would too, is we haven't had true price discovery in the markets for a long time because of all this intervention.
We have not, and we have also become accustomed to the coaching and the I would say kvetching, the coaching from the sidelines, the likes of Jay Powell. So he has a press conference and he gives a little forward guidance. And what does forward guidance mean? It means that they are telling you how it's going to go.
Yeah.
No. I would say that he has no, as intelligent a man as Jay Powell and as well-intended as he is, he has no better clue than the guy who's driving his cab where interest rates are going. He's shown that. He has no better clue as to where inflation is going to come. He has no better clue, and the Fed has no better clue as to what the confluence of credit forces might do in 2007, given the excesses on display for the previous 10 years. I had no idea what was happening. So the Fed ought to get out of the stargazing business. It certainly ought to get out of the business of pretending that it has a view of the future.
Mm-hmm. Yeah, and to your point about the cabbie, I mean, when you look at the Fed's success rate in terms of predicting where things like inflation are going to go, I bet you the cabbie's probably better than they.
Yeah.
They've got a pretty miserable track record. All right, well, look, let's get back to the inflation conversation. So, having read some of your recent pieces, it seems to me that you think that stagflation is going to be the order of the day for a good while from here. If that's incorrect, please correct me here. But in providing your reaction to that, can you give us your sense for how committed you think the major central banks, primarily the Fed, are to doing what they need to do to get inflation down to the targets they want it to be? Yeah. Because for everybody expected the Fed to pivot a lot, or most people expected the Fed to pivot before here, but we are now beginning to see central banks blink around the world, right? We saw it in Europe, in England, Bank of England. We're seeing it now in Japan. We just saw it this morning with the Bank of Canada. They did just hike a little bit more, but less than forecast. So it looks like they're beginning to maybe lose their resolve a little bit. What do you think?
I think stagflation is likely. I'm not. I can't say I'm overly confident in that outlook, but I think that's likely. I think that that one of the features of the present day is the collective attention span, and people say, yeah, they're going to blink because inflation will have peaked. Last summer, I had our very talented and enterprising intern, Declan Hurley. I had him go back and read news articles from the 1970s, every year in the 1970s, looking for the phrase inflation is peaking. And every year, some eminence from Wall Street or Washington would say, yeah, it's about over now. It's peaking. And it was one supply shock after another in oil and other things. And then the Fed declared victory prematurely. And the inflation that began in 1965 and 66, it was 1967 that then Fed Chairman William McChesney Martin said the horse of inflation is out of the barn. 1967, it peaked in 1980 in the CPI, and it peaked in the bond market in 1981, but retested in 84. So it was almost 20 years of inflationary mood music or inflation itself. And so everyone here is looking for, yeah, okay, it'll peak in the second week of November, and then we will anticipate a glide down to 2%, and the stock market's going to rally 50%. No, 65%. You know, CNBC's full of these guys, and who knows, right? But I think that we ought to keep open one share of our collective anticipations for the possibility, not that we have a literal replay of the 70s. History is not that obliging to give us a replay, but ought to at least admit the possibility of an inflation that is rather more deeply entrenched than we acknowledge, and that it crops up like one of these forest fires, right? That is, or a underground coal fire that burns and then flares above ground. People say, "Oh, glad that's over." Then, whoosh.
Yep, that's a great analogy, the underground coal fire.
So I think that is I was one of the ones that say, Jay Powell, look at what he did, and name the year. They always blink. That was a little bit too glib, but they have. I guess I'm repeating myself now, Adam. But they have said, nope, no more equity market put. We're not going to rescue the stock, but they are prepared to rescue the Treasury bond market. And at our grants conference once a year, we had one last week, and Tom Honig, who was the president of the Kansas City Fed, who earned his bones by being the lone dissenter on QE in the early years of that experiment. Tom Honig said, when they came in 2019 and said, we're not doing QE, this is after the so-called repo crisis, the repo rate got to 10% in September of 2019. He said, he quoted the Fed saying, we're not doing QE yet. We're just going to buy a lot of Treasury bills. And Honig said, no, that was QE, and the market knew it. Market knew it. And it will know it again. So that is one possibility that say next couple of months we get inflation numbers that go from it used to be 8, and say it's 6.5. People say, "Ooh, that's pretty good." If you project that out for 3 or 4 months, we're back to 2, right? And then next month you get to maybe 6 5/8. Oh God, that's not going the right way. So we are addicted on our phones to having things click and trends be inviolable over the course of it. So I don't think it's going to work that way. I think it's rather more protracted, rather more flummoxing. But as things continue to droop and to drop on Wall Street, there will be opportunities of opening for people who are willing to examine things a little bit less emotionally, and there are bargains to be had. And I think it's going to be okay for serious investors.
Great, and so I want to get straight into that part of the conversation real quick. I'm hoping you can kind of help me think through something my brain's been chewing on for a bit now, which is totally understand everything you just said about why inflation very well may be a lot more protracted and messy than we'd like to in terms of bringing it under control. That being said, economic growth in general, I know that we're going to have a pretty 2-point high print for Q3. But economic growth is definitely slowing around the world, and no surprise, especially with rates increasing as quickly as they are. We're going to have all the negative wealth effect elements that you and I talked about. So the likelihood of a recession is pretty good. Bloomberg economics puts it at 100%, but
Uh-oh.
nothing's ever 100% in the world.
Sounds like a boom to me.
Yeah, exactly. But when I look at where the macro trends are heading, sort of supply chain shortages aside for a moment, there's a lot of sort of deflationary trends that are going to be pulling economic growth down and should be pulling asset prices down.
Yep.
So if the Fed does pivot because something breaks, right? And let's say the Fed goes back to QE, right? Two things. One, there's always a delay between pulling the lever and seeing the manifestation of that. And I think even if the Fed stopped hiking right now, we're going to see a few quarters probably of the ramifications of the hikes that have been done to date still playing through the system. And secondly, if the Fed does QE, I can see maybe financial asset prices getting a boost, but we had a ton of QE for the past 11 plus years, and it didn't manifest in higher CPI. It wasn't really until we had fiscal stimulus that directly injected liquidity into the veins of the economy that things really started exploding. So even if the Fed pivoted, would we really see a recurrence of CPI the way that we did back in the 70s when we were hiking, tightening?
Oh, one of the curious things about the social science we call economics is that even follow the social science, and it's not much of a rallying cry, is it? Is that
but it's not physics, is what you're saying.
The roots of inflation are still controversial after all these millennia. That people will say inflation is always and everywhere a monetary phenomenon. And they say, yeah, well, except for, well, they say it's always everywhere a supply chain. No, so I think that we are inherently an inflationary society because inflation is basically something for nothing. Inflation is it's debt forgiveness. It is government stimulus. It is entitlements. It is consumption without corresponding production. Essentially, yes. That's the underpinning of it.
And it can solve today's problems, and we'll let tomorrow's people figure it out.
Yeah. So to be sure, money supply is not growing. To be sure, there are all sorts of signs that the supply of things is greater than the immediate demand. Witness inventories that are problematic. Witness the Christmas sales going on now. And what month is it? Not December.
Not even Black Friday. Yeah.
Yeah, but anyway. So I think that inflation is partly, I think it's going to persist as a problem, and I think it's not going to get back to 2%. And I think that bond yields are likely to be rising rather than falling. They might well fall if we fall into an obvious recession. The Fed is, I'm now talking on both sides of my mouth, but I think my long-term view is that this is an inflationary era, that paper money itself is prone to inflation, either of the asset kind or of this Main Street kind. And that if politics continue in their, I'm going to call it collectivist or statist vein, that we have the continuous risk of the direct infusion of money into people's wallets that we experimented with in 2020 and 21. So I think that is the backstory to our inflation.
Okay, thank you. All right, well, let's get to your comment about for the investor who is paying attention as the story unfolds over the coming quarters. There may be some opportunities to spy some value emerging. This program is watched by regular people who I think really appreciate the macro trends that you and I have been talking about here, Jim, and their biggest question is just how do I navigate this really, like, without becoming collateral damage to these great titanic forces that are going on. I guess first question is, what's your market outlook, and then maybe we can get into what sort of guidance recommendations would you have for that average person with that goal?
Yeah. Well,
Our interview with Jim will continue over in part 2, which will be released on this channel tomorrow as soon as we're finished editing it. To be notified when it comes out, subscribe to this channel if you haven't already by clicking on the subscribe button below, as well as that little bell icon right next to it. And be sure to hit the like button too while you're down there. And remember, we're continuing our practice of publishing my top takeaways from these weekly interviews. To get mine from this interview with Jim for free, just go to wealthion.com/adamsnotes. And finally, if the challenging macro outlook that Jim has detailed in this interview has you feeling a little nervous about the prospects for your wealth, then consider scheduling a free, no strings attached portfolio review by a financial advisor who can help manage your wealth, keeping in mind the trends and risks that Jim's mentioned here. Just go to wealthion.com and we'll help set one up for you. Okay, I'll see you next in part 2 of our interview with James Grant.